private market funds, both equity and credit, they've gained in popularity, especially with potential eligibility for inclusion in retirement accounts. And there's no shortage of products that have either already launched or filed to launch.
All right, joining me will be Chris Getter, Managing Director and Portfolio Manager at Simplify Asset Management, who currently offers 39 ETFs, about $12.5 billion in assets, including an ETF that resides in a category that continues to garner a lot of attention. I would say for both good and bad reasons, and that's private credit. So the ETF is the Simplify VettaFi Private Credit Strategy ETF, ticker symbol PCR. This tracks an index comprised of private credit-focused business development companies and closed-end funds. And then in addition to that, this ETF can deploy a credit hedge. I'll let Chris explain all of the details of this, but as part of our conversation, we are going to go through 4 key considerations when investing in private credit investment vehicles, which I think these will really help to shine a light on both PCR's approach and also the private credit market overall. And then I'm also going to have Chris offer some thoughts on private credit in general, just in terms of the investment case, because again, there have been some negative headlines here recently. So he'll join me a bit later. To start this week, I will be joined by Todd Rosenbluth, Head of Research at VettaFi. And we are going to discuss 5 areas within the ETF market that have our attention right now. And all of these, I would say, are tied to flows in one way or another. Todd has 3 of these. I'm bringing 2 to the table. And in just looking at our list here, I would say this is pretty expansive. There are some interesting topics that I think cover some of the pretty big themes in the markets right now. So we'll get into those momentarily. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now welcome in my good friend, Todd Rosenbluth with VettaFi, who is continuing to gear up for the Exchange Conference in March, which is less than, 50 days away? Is that right, Todd?
That's right. Good to be with you, Nate. And yeah, the countdown under 50 days is already happening. I'm really excited about the conference. We have approximately 600 advisors that are signed up and many more that have engaged with us to start the process. Let me give you a little bit of the stats and why I'm excited. So 40% of those registered advisors are RIAs, and a growing close to 40% are independent broker-dealers. I know for advisor listeners, they want to be with their peers. For asset manager listeners, they want to make sure that they're talking to people who might be able to buy their ETF. I think this is a heavy hitter group of folks that are experienced. So 2/3 of those that are registered have 15 plus years of experience in managing money, and 57% are managing over $100 million. So this is a great group of advisors that we already have signed up and more to come. My main role is helping to plan the agenda, and we've got speakers lined up for Monday, the first real day of the conference, from BlackRock and State Street Investment Management, JP Morgan, Van Eck, that'll be on stage. And then Nate, you'll be on stage also. I think you're going to be talking crypto, surprise, surprise, with some folks. And then we'll have managers of active fixed income strategies. We'll talk about alternatives. It's going to be a great agenda. It's going to be a great event. So I know many people have already signed up, but if you haven't, or you haven't gotten approval from your boss to be able to go to exchangeetf.com.
Well, I'm really looking forward to it. I'll also be doing a ETF due diligence session on that Sunday. And then, of course, I will be hosting this podcast live on the Tuesday of the event. And I know I always say this every year, but I genuinely feel like my favorite part of this event is just being able to see people in person. A lot of people who listen to this podcast, guests that are on this podcast, that's just always one of my favorite parts, is being able to see people live and not just via video like we are here. So hope everybody will join us. Okay, Todd. So we are about a month into 2026. And I thought this might be a good time to take an initial look at ETF inflows so far this year and highlight what's been standing out. And as I mentioned, we have 5 areas to cover here. You're bringing 3, which I know you recently wrote about these as well at etftrends.com. And then I have 2 for us to get into. But before we do that, anything you want to highlight on ETF inflows overall after this first month of the year? Any big picture stuff?
Well, I think it's just been a tremendous start to the year. Everybody that's listening to this probably knows we hit a record $1.5 trillion of net inflows. It's reasonable to think that maybe there'd be a pause. And as you and I'm sure others know, there's a bit of noise that happens with ETF flows. A lot of money goes in at the end of the year to S&P 500 based ETFs like SPY. And so SPY has seen outflows for understandable reasons. People piled in at the end of the year. So the latest data that I saw was we were approaching $150 billion. Obviously, that might change by the time the month ends up with a close, and we have the full data that's there. Vanguard 500 and the Spider S&P low cost ETF S&P 500, which is SPYM, those together was approximately $25 billion. So snow or shine, I think people continue to turn to ETFs. And it looks like $1.5 trillion could be that floor as opposed to that ceiling.
Yeah, if you just do the math on the flows we've seen thus far, that roughly 150 billion in inflows, that puts us on pace for what, like 1.8 trillion for the year. Which, I remember going back several years ago, the big talking point was, could we eclipse 1 trillion in inflows? And when would that happen? Now we're already talking about 2 trillion in inflows. It's just unbelievable.
Since we're recording this together, and I don't know how you're going to do my teaser. My teaser, when I used to come on, when it was just audio instead of video and audio, was $1 trillion or approaching $1 trillion. So I'm glad we retired that because the ETF industry has certainly moved on. But there's some great trends that are happening, I guess, a little bit deeper beyond the traditional market cap weighted S&P 500.
Well, let's actually get into some of those. So we know, again, big picture, investors are continuing to gravitate towards ETFs. That's not a news story. But as we dive further into the flows over this first month or so, again, there are 5 areas that are standing out. And I'll just go through yours first, starting with actively managed ETFs, which, Todd, you love this category. It's always actively managed ETFs from you. But I'll ask you, what has caught your attention here? Or is it just more of the same, similar to what we were talking about with flows overall?
Yeah, so I chose 3 things that have stood out to me. Some of them are what worked last year is continuing to work, and some of them are a little bit different. This is what's worked last year is continuing to work. So I work for a differentiated index provider company. I'm sure my colleagues would like me to highlight other things, and I will highlight other things too, but active fixed income ETFs in particular have been in demand. We saw roughly a third of the overall flows in 2025 were to active, and 40% of the overall flows to fixed income last year were to active fixed income products. And that, again, is happening. So PIMCO's multi-sector bond active ETF, PYLD, crossed $1 billion of net inflows thus far. In January, we've seen strong demand for the iShares Flexible Active ETF, BINC, and the Fidelity Total Bond ETF, FBND, JP Morgan's Income ETF. And this is all in a period when the Fed did nothing recently in cutting rates, and there's expectations they may not do anything for the foreseeable future. People are turning to active fixed income ETFs. That's more of the same, but it's still notable to call out.
Do you think that 40% number, so again, 40% of inflows going into active products, and certainly there are a lot of different flavors of active. We've talked about that. Some things that are quote unquote active aren't really quite as active when you look under the hood, but let's put that aside. That 40% number, do you think that's the new normal? Is that sort of the baseline moving forward, or would you expect that to come down, go up? I'm just curious, what does that number look like moving forward?
So I do expect it to come down. I think some of this, well, I think this is going to come down with the catch that we'll see what happens if and when we get share classes of ETFs. Not if and when we're going to, but we'll see how many of those. And I don't want to belabor that point. We've talked about that in the past. But I think people are turning to active during times of uncertainty. There's some new managers or firms that have been around a while in the mutual fund world, but have now entered the ETF space. And that's going to garner interest. I don't think anybody believes the ag is the right index, that it's broken. Many people have said that of what it holds and doesn't hold, and how concentrated it is in treasuries. So in fact, we're going to talk about it at a virtual event that we're having. VettaFi is hosting, about other ways to do indexing within fixed income. And I think that's going to be more relevant going forward. But active fixed income has been popular. I think it will remain popular. 40% is hard to maintain.
Okay, so actively managed ETFs, that's one story that's on your radar this year. The next one that caught your attention is thematic ETFs, which I actually covered these a little bit on the podcast last week, but I thought this was interesting because you specifically mentioned the geopolitical backdrop actually driving some inflows here. So talk a little bit about this one.
Yeah, so the last time that I was on, and what I was looking for 2026 was whether or not artificial intelligence and related ETFs would continue to remain in focus, because they were very popular the last 3 years, and they were the darlings of the ETF industry. So an ETF like iShares AI Innovation and Tech Active ETF BAI, I believe I called out. It actually it's seen inflows this year, but more modest inflows. And what really is leading the charge is defense-related ETFs, as you mentioned. So Global X Defense Technology ETF, SHLD or SHIELD, has gathered over $1 billion in just the first month. It had a good year last year in terms of gathering assets, but it's come out even stronger, and the pace that it's on, it holds companies like you would think in defense, like Lockheed Martin and Northrop Grumman, but it also owns Palantir Technologies. And when I last looked at the performance data, it was up 20% for the year. But what also caught my eye was a more recently launched and smaller thematic fund, the Rex Drones ETF, DRNZ, or drones, if you were to spell it out without vowels and have fun with it. That's up 29% from a performance standpoint. This ETF launched in October of 2025. It's about 60 million in assets under management, and it's has exposure to military and defense companies, but also drones are used for industrial applications like agriculture and construction. And so this is a pretty cool ETF, I think, that's been gaining traction and certainly has been performing quite well. So those two caught my eye, as opposed to the old school artificial intelligence, the ETFs.
Yeah, and I would just say overall, it feels like thematic ETFs are making a real comeback. You go back a couple of years, there was a lull in flows into these products, but last year we started to see some momentum, as you mentioned, around AI ETFs in particular. Now to see these types of categories performing, something like defense or in drones, I just think is an interesting story. And I think part of that, and maybe this will get into the next category that has caught your attention, is just investors looking to diversify their portfolio, because it's the same narrative. I know we both have talked about it ad nauseum. There are concerns about the top heaviness of the S&P 500 and other market cap weighted indices. And so if investors want to diversify away from that to a certain degree, they'll look to thematic. So I think that's a good one. And let's just get into this third category that has caught your attention. And I would say really this is more of a broader market theme, but it could definitely have real ETF impact. And again, this is that note there are early indications investors seem to be diversifying away from US mega cap ETFs. My question for you is, people have been saying this might happen for a while now, but what are you seeing in the early flow data?
Yeah, so I think for much of 2025, you and I and other guests of yours talked about the need and why people should consider doing so, but they didn't diversify. So RSP, the Invesco S&P 500 equal weight ETF, was one of those rare ETFs that was large and bled assets in 2025. I think it had over $3 billion of redemptions. Well, this year, to start January, it crossed the $5 billion net inflow mark when I looked at the data and ran it. And so it's working to diversify. So the equal weight S&P 500 had been outperforming the cap weighted S&P 500 through the first 3+ weeks of January. Stocks like Moderna and SanDisk, these are S&P 500 companies people probably are familiar with, but they're quite small relative to Apple and Nvidia. Those stocks have outperformed. And then what also caught my eye, even though it hasn't performed as well, is XLF. So that's the State Street Financial Select Sector Spider ETF, $1 billion, I believe, of outflows. And then it's been one of the top 10 asset gatherers, close to $4 billion of net new money this year. And so banks have shown some strong quarterly results. The performance hasn't been there because uncertainty tied to the Fed, but investors are looking to sectors that are not technology and communication services. So that certainly caught my eye in the ETF space.
Yeah, I think my only pushback on this one overall, and pushback's probably not the right word, but just with this thought that investors are diversifying away from US mega cap ETFs, is that you were alluding to this earlier. If you look at the inflow leaderboard right now, I mean, two of the top three are, of course, VU and SPYM, so two S&P 500 ETFs. And then you look at number 5 on the leaderboard, you see VTI, of course, total US stock market ETF. So the point is, investors are still allocating here. And, does that ever change? I mean, will we ever see something other than VU at the top of the leaderboard? I don't know. But I also, on the other hand, agree with you that there are early indications that the overall composition of the ETF leaderboard is changing. So I think, as you know, I've talked a lot about interest around international ETFs. And right now, number 2, believe it or not, is IEMG. So the iShares Core Emerging Markets ETF, you mentioned RSPs having a really good year. So again, pushback's too strong of a word. I think you're right in that investors are looking at other areas besides S&P 500 or US market cap weighted ETFs, but it's still early here as well. We're not seeing that investors are just fully divesting of those positions.
So the same way that you can be a advisor running a strong practice and be an ETF expert that's worth being on stage at exchange, people are both putting money. Some people are putting money into market cap weighted ETFs, and I think that's going to continue. But some others are diversifying their portfolio or tilting away from just the market cap weighted products.
Okay, so those were your 3 categories. Let me give you 2 that have caught my attention, which I don't think either of these will surprise you, but I think both worth talking about. And the first one is silver ETFs. And probably we should add gold ETFs in there as well. Here's what's interesting, Todd. So silver is up about 65% this year. 65%. We know what it did last year. But if you look at the iShares Silver ETF, SLV, guess what? That's seen something like $2.5 billion in outflows as of the time that we're recording this. Now, if you look at gold, gold is up nearly 25% year to date. And that category has seen big inflows, almost $5 billion this year. But any thoughts as to what's going on with silver ETFs? I mean, do you think this is like a little bit of profit taking, or it's just an odd dynamic? Typically we see if you have performance in a category that is outstanding like this, you'll see the flows follow, but we're not seeing that here.
So I guess you're right. And so a couple of things. I guess silver is at a unique juncture. It's tied to macroeconomic policy and uncertainty of the next moves tied to the Fed. It's tied to the technological transformation. There's connections to artificial intelligence and resource scarcity. What caught my eye as last week is that SLV, that iShares ETF you talked about, I think it's on one day 15 times its average daily trading volume. So to me, this is short-term trading and not flows. And whether this is a retail crowd, whether it's an institutional crowd, I'm less qualified to be able to tell you who exactly was trading that ETF, but the outflows are there. But what I caught my eye also is there's an ETF that maybe you're familiar with, the Sprott Silver Miners and Physical Silver ETF. The ticker is SLVR. It launched a year ago. It's approaching $1 billion. It combines silver, as the name would suggest, it combines the miners as well as exposure to silver. And it's launched in the past year. It's gathering assets, despite the fact that the leading silver ETF is out of favor. I think you want me to talk about gold so we can set up your next point on the audience can guess what you're watching this year. But you're right, gold has been a strong performer, and GLD and GLDM, I think combined have about $4 billion of net inflows in January. So there's been growing adoption both of institutionally minded investors for GLD and more retail advisor minded advisors that are using GLDM. And at the risk of another plug for the exchange conference, we're going to be talking, or I think I am going to be talking on stage with the experts at State Street Investment Management about whether gold still has legs in the rest of the year. So another reason for people to be at the conference.
My very quick take on what's going on with flows is that I'll speak from a financial advisor perspective, who we know financial advisors drive a meaningful chunk of flows into any ETFs. I think advisors are much more comfortable holding gold as a core position within a portfolio. And so I think when we see the performance that we have and advisors think about everything going on with a weaker dollar, potentially rates coming down, there's still sticky inflation, we have geopolitical concerns across the globe, those sorts of things, they view gold as a hedge. Whereas silver feels much more retail-esque to me. This almost feels like a fear of missing out, where we have this amazing performance and we're seeing retail investors try to pile in and take advantage of that. I think that's one of the reasons you're seeing the interest around silver miners, because I think you can think of the miners as like a leverage play on the underlying metal, right? So certainly you have institutional traders who are probably attempting to take advantage of retail, which is why you're seeing trading volume spike. But I don't know, it just feels very FOMO to me. And we'll see if the performance continues the way it is. Maybe you start getting some bigger looks from advisors. I just don't think financial advisors traditionally allocate to silver in a portfolio on a standalone basis like they do gold. One other point I'll mention is if you look at some of the inverse and leverage products, something that stood out to me is the ProShares Ultra Short Silver ETF, ticker ZSL. That's actually taken in about 700 million this year again. So that's people betting against silver as it's run up, which I think is another good indication that maybe this was a retail-esque type trade. Okay, the other area that I have to highlight is the crypto ETF category. Or probably more accurately, this isn't a highlight, it's more of a low light, because these products have seen outflows overall this year. If you look at all of the broad categories of ETFs, crypto ETFs right now are the only broad category with outflows in 2026. And in contrast to what we were just talking about with gold and silver, Bitcoin and crypto are down so far in 2026, or about flat. Now, the outflows from this category haven't been horrible, I think, especially given the performance in the space over the past 6 months or so. But I think this will be an interesting one to watch moving forward, because let's say Bitcoin continues to underperform. Again, it's about flat this year, up a percent. But if you have gold and silver continuing to run, does that create some issues for the Bitcoin narrative? Now, I'm not saying that's what's going to happen, Todd, but I do think some investors will be asking questions around, is this really digital gold? Is Bitcoin really digital gold? So do you think that if we continue to see gold run and maybe Bitcoin flounder a little bit, that could poke some holes in the argument of Bitcoin as digital gold?
So that's a lot for me to chew on. Let me start off with that. Your next guest is going to have lots of great insights to talk about alternatives and how much room you have in your portfolio for alternatives, and how you should sort through the choices of alternatives, because Simplify offers some great products. in that space. But I do think there's a limit to how much you can have that's not stocks and bonds for many people. And so you're choosing among the commodities, you're choosing among crypto, you're choosing among private credit, you're choosing among other things that's there. I would note a couple of things. IBIT has seen inflows this year. I believe the Fidelity product, FBTC, and at least one, the leading grayscale product, GBTC, they've got the outflows that have offset this. So it's not significant outflows, and it's not everybody within that space. You touched on, I think 2 episodes ago, the VettaFi Bitwise crypto assets survey with one of my colleagues. You reminded them about the survey and the demand and what was going on. So let me just give a couple of stats that I don't think I heard you say. This is a study we did in partnership with Bitwise, and 32% of advisors reported allocating to crypto and client accounts in the past year. That's up from 22%. 56% of advisors owned crypto in their own personal portfolios. So more people are owning it on their own to get the experience and exposure, and then they're talking to clients. And the allocation has increased. So roughly 2/3 of the portfolios that have crypto exposure, it was greater than 2%. That's up from just about half of that. So we are seeing growing interest from advisors. Obviously, crypto has to, and Bitcoin in particular, has to perform well enough to justify its role within a portfolio. But I don't think you are bearish on the demand for crypto ETFs. But I think we're still very early days, and I think the future looks quite bright for these products to continue to gather assets.
Yeah, I'm obviously not bearish on this space longer term, but I do wonder, again, if performance continues to lag, what happens with flows into these products. And it has been, you look back, really go back to when the spot Ether ETFs launched in July of 2024 and look at the performance. It just hasn't been spectacular overall. So I just wonder, at what point does that cause investors and advisors to either not be interested in the space or stay away from it altogether? I don't think that's what's going to happen, but it is something that I'm watching for the remainder of the year. But Todd, we'll have to leave it there. Great stuff as always. Thank you for joining me this week.
It's a pleasure. And your next guest is also going to be on stage with us at Exchange.
That was Todd Rosenbluth, head of research at VettaFi.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Chris Getter, Managing Director and Portfolio Manager at Simplify Asset Management, who currently offers 39 ETFs, about $12.5 billion in assets, including an ETF that launched in September of last year. That's the Simplify VettaFi Private Credit Strategy ETF, ticker symbol PCR. And that ETF, along with the private credit market in general, will be the focus of our conversation this week. Chris is joining me from Las Vegas. Chris, it's a pleasure. Welcome to the podcast.
Thanks, Nate. Great to be here. Appreciate you having me.
All right, so we are going to have a pretty in-depth conversation around private credit and certainly the PCR ETF. I'll tell you, I feel like this topic of private credit has generated a lot of attention recently. I said at the top, for both good and bad reasons. But I guess first, before we get into all of that, I thought it might be good to have you just describe the basic case for owning private credit. And perhaps you can even explain what private credit is. I know there are some people who maybe don't fully understand this market. So let's start there. Explain what private credit is, and then how do you see the basic investment case around it?
It's tempting, Nate, to just start by breaking down the name. Like, it's credit, lending money, and it's private, which means the securities are negotiated directly between the lender and the borrower rather than being issued in the public markets and traded continuously thereafter. But I think that does a bit of a disservice to the asset class, because the key is what the private nature implies about yields and returns that matters here. If I look at investment grade yields today, about 4.8% on average, high yields about 6.5%. If I look at the dividend from all the securities that are captured in the VettaFi private credit index, it's around 15%. And those higher yields over the 8 years that the index has been in existence have accumulated to returns which are about 3 times what you can get in investment grade, probably about 1.5 times what you can get in high yield. So this is a credit asset class, but it is one that trades, well, it's one that doesn't trade, right? It's issued directly and it's generally held by the creditors. And then the one other difference I think is important is most of this indebtedness is floating rate in nature. So if you're concerned about interest rates going up, it's a bit of an issue for both high yield, durations about 3. It's an issue for investment grade corporates where duration is almost twice that. But most of this stuff is floating rate. So it's a yield play, it's a return play, and then third, it's a way to be a little bit more defensive on your risk.
Okay, so with the Simplify VettaFi private credit strategy ETF, I know there are 4 key considerations that you believe are most important when investing in private credit. And you have attempted to address all of these with PCR. And so I thought, let's maybe walk through each of these one at a time, because I think these will really help everybody understand PCR's construction itself. And again, just the private credit markets in general. And so the first consideration is liquidity, which this always comes up when talking private credit. So how is PCR addressing this?
At the heart of Simplify's core mission is providing investors access, especially to asset classes that have generally been reserved for large institutional investors. And in the private credit space, that's historically been achieved through partnership structures, GPs, LPs, long lockup periods, which are by construct not liquid. But the VettaFi team has been kind of what I think of as at the forefront of innovation here, and they took a slightly different approach. They built an index which was comprised of business development companies, BDCs, and closed-end funds, CEFs. These all trade daily, but they're all in the business of private credit. So you've got private credit issued by business development companies and closed-end funds, and then you've got the index which captures those. And then on the Simplify side, we are using total return swap on the index to deliver the index performance to investors. And getting into the mechanics of that is probably beyond the scope of the discussion here, but doing it with a total return swap gives us a lot of flexibility in accommodating our clients' activity, the flows into and out of the ETF.
Okay, so really just to summarize that, the fact that the index itself is focused on business development companies and closed-end funds, obviously both of those trade daily, unlike traditional private credit. And so that offers that liquidity. And then the fact that you're using total return swaps to get this exposure, that provides the flexibility with creations and redemptions, which obviously can help in the overall liquidity as well. Okay, so that's one consideration. I know the next consideration that you're attempting to address with PCR, and I like this, is what you call stored volatility, which I'd love to have you explain this concept because this always comes up when people talk about private credit, volatility laundering and those sorts of concepts. So you can explain what you mean by stored volatility and then how you're attempting to address that in this ETF.
In my experience, lack of trading often masquerades as low volatility, right? If something doesn't get marked every day because it's not being traded every day, nobody's making bids and offers on it, people will say, oh, it has no liquidity. not really. It's true that private credit instruments, like the actual securities between the lenders and the borrowers, they trade infrequently, if at all. But the fundamental credit health of the borrowers changes continuously, for better or worse. In the public credit markets, you see those changes in credit health reflected in spreads or prices throughout the course of the day, almost instantaneously. But in the private market, we end up with what I call store volatility. And instead of that constant dynamic adjustment, it shows up all at once as a sharp drawdown during periods of market stress. So what we've done in PCR is to use our proprietary quality minus junk credit hedge. Investors in our high yield fund, CDX, might be familiar with this, but we recalibrated it to the credit index. And our goal here is to provide some cushion during those drawdowns to deliver a better overall return experience in terms of not only the return, but the volatility as well for the investors who want to invest in private credit. So stored volatility, the direct answer to your question is the propensity for things to build up and then, like a dam, bursting. And then the way that we've attempted to mitigate that in PCR is through the use of this credit hedge.
And we don't have to get into all of the mechanics here, but just at a high level, can you explain how that credit hedge functions? How does that work?
Yeah, so when I say we, I primarily mean my colleague Mike Green, has written extensively on this. There's tons of information on our website. So let me try and delineate what we're doing here. We start with the constituents of, let's say, the Russell 1000. And the first distinction we make is to separate them into quality names and junk names. Quality names are generally those companies with stronger balance sheet, more stable profitability, higher margins. Junk names are those whose their ability to stay in business is more sensitive to a rise in financing costs, whether that's yields or spreads. Now, because the junk names are inherently relatively more likely to default in times of market stress, when access to credit becomes constrained, they will underperform. And the quality names they may also have negative return, but they will certainly outperform the junk names. And so what we do is we put on a hedge that is long quality and short junk. And in times of market stress, again, they're both going down, but because we're short the junk names and they're going down a lot more, it ends up providing some of that cushion against the moves in the asset class. And the objective here, from my perspective, having been a credit person for my entire career, is the best thing you can do for an investor is save them from the downside, right? Bonds are going to pay you back 100 at par. They're going to be like, hey, thanks for lending us money. Here's 110. No, it's 100. So in cases where the market is subject to a drawdown, you really do better by limiting that than you do trying to reach for yield on the upside. And that's what the credit hedge allows us to do. And it's also positive carry. So the dividend yields, for example, on quality stocks, higher than the dividend yields on the junk stocks. So even if nothing happens, we still get paid to hold that hedge. And that alleviates the burden of us trying to guess, or even if we think it's an informed guess, on when the market might sell off.
And just to be clear, that credit hedge, if people go and look at the holdings of PCR, that exposure is via total return swaps as well, right? They're not going to see you long a bunch of stocks and short others. It's via this total return swap.
It is done via total return swap. If you go to our website, you can actually see the holdings, the individual constituents of quality and junk. You'd have to drill down to do that.
Okay. So we talked liquidity, the stored volatility challenge that you're attempting to address with PCR. The third challenge you're addressing is manager selection, which I think this is pretty straightforward, but I'd love to have you expand on that.
So every time credit is extended in the private market, someone is saying, yes, we think we're getting paid enough to lend to this borrower. In essence, every decision in private credit is an active one. And as with any other asset class where you have a grouping of actively managed strategies, some are going to do well and some will do not so well or not as well. So let's just take the VettaFi private credit index. Over 50 constituents between the closed-end funds and the BDCs. Last year, the best performer was up over 16%. The worst performer was down 29%. So that's a 45% gap. Now, if you're just picking one of those index constituents, your happiness with the decision to allocate to private credit is entirely a function of how well your manager did. So PCR, to try and mitigate that, takes exposure to the index, and you have built-in manager diversification. So what this allows for an investor to do is to answer one simple question and implement. And that one simple question is, do I want private credit exposure or do I not? And if I do, I can invest in PCR, get the whole basket, and then I don't have to take what would ordinarily be the second step, which is sifting through all of the possible ways to implement it in terms of this manager, that manager, good, bad, looking at all the statistics that people use to select managers.
That diversification, that approach makes total sense to me, but how are you actually determining those holdings to begin with? Which BDCs or which CEFs to invest in?
So that's all done on the VettaFi side. And they've basically gone through and said, okay, here's the universe. It's private credit funds, it's business development companies, closed-end funds. And then they look through to the underlying holdings to gauge whether or not they are, in fact, in the business of private credit extension. There are some closed-end funds which are not. There are some BDCs which are not. So the goal here is to try and refine what is a very broad universe down into a tractable set of names that actually do what people want to do with their capital.
Okay. And then the last challenge that you're attempting to solve for with PCR, and I think this is clearly an important one, is to offer better purity of private credit exposure, which you say can be a real challenge with some of the ETFs currently on the market. And I think that, I'll let you elaborate, but I think that comes down to the fact that the SEC limits a liquid holdings to 15% of a fund's assets. But talk more about this one.
Private market funds, both equity and credit, they've gained in popularity, especially with potential eligibility for inclusion in retirement accounts. And there's no shortage of products that have either already launched or filed to launch that aim to provide access to the asset class, to unlisted securities. But those funds, as you mentioned, Nate, are governed or constrained by the SEC's 15% limit on illiquid investments. You say, okay, what about the other 85% of the fund? And it's often being backfilled, or that 85% is being filled up with plain vanilla credit instruments, publicly traded stuff, IG or high yield, could be government bonds, could be mortgages. But because we are, and it ends up not being a pure exposure, as you say, but because we are using the total return swaps that I mentioned before to deliver the return of an index, which is comprised of private credit, we're delivering what I think of as a more unadulterated exposure. It's all private credit all the time.
So let me ask you this. So let's assume that's the case, which I think it is, and you're offering purity of exposure here. Are investors losing anything by accessing private credit via business development companies and closed-end funds versus quote unquote direct private credit exposure, say through like a traditional private debt fund?
So clearly I'm biased on this, but I would go back to the spirit of what Simplify does in terms of providing our clients access to institutional grade strategies. And another part of this is just making investors' lives easier. And in that spirit, we can kind of compare and contrast. And I don't know whether individual investors would consider these features or benefits, but traditional private credit, you've got a lockup, right? Like you're not getting your money back. That's the definition of illiquid. This is a daily liquidity ETF. You can choose to own or not own private credit through PCR whenever you like, and you can transact that at a market determined price. That's number one. Number two, traditional private credit, high fees. It's often fees on the drawn capital that includes both a management fee and an incentive fee. So you don't know a priori what those fees are going to be, and you're paying them regardless of whether the manager hits that target or not. And you have to pay back fees in many cases if they lose one year and then start catching up the other year relative to their hurdle. PCR 76 basis points, period. You're also not going to get a K1 as you would with most private credit direct investments. This will just show up on your brokerage statement that your broker sends you at year end for taxes. And then the last thing I think that's important is In PCR, we've already talked about the credit hedge, but generally speaking, there is a limited ability to hedge adverse risks in traditional direct lending vehicles. That's not part of the mandate. Here, we've got it fully integrated through that quality minus junk hedge.
Okay, so I think you've done an excellent job of explaining the basics of the private credit market and certainly walking through how PCR is getting exposure here. Let me ask you this. Where do you see an ETF like PCR fitting in a portfolio? Because my sense is that a lot of investors and certainly advisors, they might view this as a fixed income holding. And so therefore they would place this in the fixed income sleeve of a portfolio. Is that the right way to think about this? Or is it more alternative exposure, or does it matter?
I tend to view it as part of the alternatives bucket. Most clients I've spoken with have expressed a similar view. And some of that might just be the novelty of private credit, right? Oh, it's an institutional barrier breaking down. We are getting access to it. It's probably an alternative. But the analytical evidence does support viewing it as an alternative. In particular, the correlations with, let's say, a traditional 60-40 type asset are low enough that it does kind of pull private credit from that fixed income into the alternatives. And then the second component is, as alternative allocations grow, as clients move from a 60-40 to a 50-30-20, there's been an emphasis on diversifying within that 20%, right? You don't want to have it all in one thing. And here again, the numbers suggest that private credit can play an important role. For example, CTA strategies, which have been one of the most popular additions to that alternatives bucket, have a slightly negative correlation to private credit over that common period of the index. So yes, it's good to diversify. It's good to put some portion of your portfolio in alternatives, and it's good to diversify within alternatives. PCR, I think, or private credit broadly even, is a good way to do that.
As I was looking at initial demand for some of the private credit related ETFs that are on the market, I would say as you look at these products rolling out over the past year or so, the demand has seemed a bit muted, maybe a little bit less than what people would have otherwise expected. And we can talk about the market environment in a minute. But my question for you is, do you think a part of that comes down to just education around private credit and what you were just referring to in terms of where this fits in a portfolio, or do you think there's more to it than that?
Part of it is there's been some bad press around it. You may be well aware, your audience may be well aware, that there was an ETF that launched last year that post-launch got kicked back by the SEC for reasons related primarily to the naming of the fund. That doesn't help. It doesn't help with credibility. So I think that's one issue. The second, and I presume you will want to talk about the market broadly, but the second issue is we've had some headlines, and those headlines have not been favorable. And third, I think it's reasonable for people to take a wait and see approach, especially as stocks and bonds have continued to deliver reasonably solid performance. I mean, you look at your equity portfolio, you say, like, I was up in the high teens last year. Do I really need all of these alternatives? I'm not suggesting that's a good way to invest using the rearview mirror, but I think those do present, I think, realistic challenges to fundraising in asset classes that aren't, that are starting to skew away from the mainstream.
Well, let's talk about some of those negative headlines that both you and I have alluded to, and we can talk about the health of the private credit market overall. So just last week, I saw that BlackRock said they're chopping the net asset value on a private debt fund by 19%. And of course, we saw Bloomberg and other mainstream media outlets run with that. We've seen comments over the past several months from Jamie Dimon talking about cockroaches when referring to private credit. I know Jeff Gundlach has said that private credit basically has only two prices, right? 100 or zero, so par or zero. How are you viewing private credit at the moment?
Full disclosure, I've never viewed myself as an evangelist for any asset class that I've been associated with. I'm always happy to share my thoughts. So I'll try and be balanced on this, but let's look at some of the facts. First, fundamentals. It's tempting to take the headlines, setting aside Jamie's comments and Jeff's comments, it's tempting to take the headlines and extrapolate that and say that applies to an entire asset class. We need to dig a little bit deeper. One indicator, and apologies in advance for getting a little bit technical here, but one indicator that speaks to the health of private credit BDCs in particular, it's called PIK interest, paid in kind interest. And that represents how much of the borrower's interest payment they're making by just issuing you new bonds instead of paying you cash, right? So imagine if you did this for your mortgage. You said, I've got a $100 mortgage. I don't have any cash this month, so just make my mortgage $105. That's what's going on here. Traditionally, the worry level has been around 10%, right? If 10% of a BDC's income is PIK, that's a bad thing. And on average, looking over the past quarter for the index constituents, that number is about 5.5%. It's actually lower than where it was a year ago. And there's a range around there. There's outliers, both zero PIK, and then there's somebody with a little bit more than 20% PIK. But that doesn't seem to me to be suggestive of a broad-based problem. Now, obviously, we'll have to keep an eye on what the direction of travel is there. But that's fundamental piece number one. Fundamental piece number two, historically, and again, we do have somewhat limited history in the private credit space. Data only goes back to about 2020. But high yield and private credit have had roughly similar default rates. So, companies that are more levered, high yield companies, private credit borrowers, they tend to be more sensitive to the economic cycle. So, not my base case, but if your scenario is for a significant drawdown in U.S. economic activity, then you and I can hang up, and people can probably go think about what they want to do with their high yield exposure, because there's probably bigger fish to fry. But all of what I just said probably could have been said a year ago, and yet credit spreads have continued to kind of hover around their historic lows. Now, the other side of this coin is to consider what's already in the price. Like, I know the current Bond King has said the price is either 100 or 0, but the previous Bond King liked to say that there are no bad bonds, there are just bad prices. And if I look at what's already priced in here, you've got BDCs trading at roughly a 10% discount to NAV, closed-end funds trading at about a 6% discount to NAV. So, when I kind of take all of that into account, the fundamentals balanced against the valuations, I actually think that private credit might be a good fit for investors who are looking to move more into the alternative space or diversify within their alternatives. And the one thing that I will preach on, since I said I wasn't here to evangelize, is that if you believe that private credit merits inclusion in your portfolio, then PCR, I think, is an optimal way to get that exposure for reasons we've been discussing.
But let me ask you this, just to clarify some of that, or maybe restate that. Let's say credit spreads blow out. So you look right now, as you know, credit spreads historically tight. Let's say those start moving in the wrong direction. Is a thought that if there are issues there, then there's going to be issues in the private markets and everywhere else, and so you should be prepared for that. I'm just trying to think, like, how should an investor calibrate that, or think about the potential risks there?
At the risk of doing a disservice to Jamie Dimon, I think if there are cockroaches in the private credit market, there are probably cockroaches in the high yield market. And generally what we've seen is that it's not so much that anything unbecoming is going on within the private credit space. It's not like, managers have abdicated their responsibility. Most of what we've seen so far, I'm thinking back to First Brands, Tricolor, their credit events, credit stresses were triggered by economic things, right? The fraud in one case, likely fraud in one case, was uncovered by a change in economic policy. And I think that it will be the economy which drives these, not so much just like, hey, we've lent a ton of money to borrowers that are no good because they were no good to begin with. Like, they can become no good if the economy turns against, highly levered companies in general, but that's not specific to private credit.
Well, Chris, again, I thought this was such an excellent overview on the private credit markets and certainly PCR. So thank you for the very clear description of everything that goes into this space. Really appreciate you joining me this week. Thank you.
Thanks so much. Great to see you, Nate.
That was Chris Getter, Managing Director and Portfolio Manager at Simplify Asset Management. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute's Certified ETF Advisor Program. You can learn more at cetf.org. I have another excellent show for you next week. I will be joined by Chris Tesson, founder and managing partner of Aquitas Investments. And then I'll also be joined by Bill Mann, chief investment strategist for Motley Fool Asset Management. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.